चाहिए वेट के हिसाब से आपको ले सकते हैं. So it's a matter of
These machines basically dispense the gold coins from 0.5 grams to 100 grams. So total 8 combinations are there, and all the people of whatever be the class, instead of going to jewelry showrooms, they can come here directly and they can get the coins here. So these coins are 24 karat gold, 999 certified. So they will get their investment return as per the live price without any wastage.
These are Hungary's traditional hairy Mangalitsa pigs, prized for their meat. Their breeders are struggling to stay in business after a punishing combination of drought and inflation. Feed prices have nearly doubled from 2021. The cost of energy and medical care for the animals has skyrocketed too. Lajos Konder's family rears more than 2,000 pigs in the east. He's hiked prices by as much as 25%, but doesn't think customers can bear much more than that.
Ebből a megnövekedett költségekből a vállalkozásoknak.
Businesses will have to swallow some of these costs to be able to bridge this situation, he says. Konder isn't alone, and others simply won't survive, according to the head of the country's breeding association. It's just one example in a country where food prices spiked more than 45% in October, compared to a year ago. That's according to Eurostat data. Food prices are the main driver of inflation in Hungary, and surging prices mean families are buying less. The cost of meat and fish is up more than 34% year on year. That means 75-year-old Eva Ratz can't buy the carp she wanted for the holidays. She has medicine and utilities to think about first. There are some people for whom Christmas will be nice, and for some, if I'm frank, it will not be, she says. Hungary is among 10 countries in the east of the European Union facing food price inflation beyond 20%. And there's no sign inflation is slowing down yet. Thursday's data is expected to show it accelerating to more than 22% in November. Hungary's national bank governor said on Monday inflation would average up to 18% next year, with food accounting for more than 50% of further rises.
Shares of the biggest U.S. banks fell sharply on Wednesday, a day after a lineup of the country's top bankers said they were bracing for a worsening economy next year as inflation threatens the spending power of American consumers. J.P. Morgan Chase CEO Jamie Dimon told CNBC on Tuesday that consumers and companies are in good shape at the moment, but that may not last much longer, adding that a slowing economy and inflation might very well cause a, quote, mild to hard recession. Dimon said excess savings held by consumers from stimulus programs approved by Congress beginning in 2020 may run out sometime in mid-2023. Dimon also said the Federal Reserve may pause for 3 to 6 months after aggressively raising interest rates, but that those higher rates may not be sufficient to tame high inflation. Bank of America CEO Brian Moynihan told investors at a Goldman Sachs financial conference that the bank's research shows negative growth in the first part of 2023, but that the contraction will be, quote, mild. And Goldman Sachs CEO David Solomon said at the same conference that, quote, economic growth is slowing, adding that when he talks to clients, quote, they sound extremely cautious. Meanwhile, some banks, including Goldman and Citigroup, are cutting jobs. On Tuesday, a source told Reuters that Morgan Stanley has reduced about 2% of its workforce, affecting about 1,600 positions. U.S. stocks ended broadly lower on Wednesday after a choppy session where investors struggled to find a clear direction following downbeat comments from the country's top bank executives who said a mild to hard recession was likely ahead. The Dow finished flat, the S&P 500 fell fractionally but for the fifth straight session, while the Nasdaq lost 0.5%, closing down for the fourth session in a row. Fears over how long the Federal Reserve might stick to rate hikes ahead of its policy meeting next week are likely to continue to weigh on the stock market, said George Ball, chairman of Sanders Morris Harris.
The barometer of up or down is the expectation of Fed rate hikes, how soon, how much, for how long. And right now, I think everyone accepts the notion 50 basis points in a few days, probably 50 basis points sometime after that. And following those two moves by the Fed, nobody has the slightest idea. Will there be no recession, slight recession? I think slight recession is the consensus, but that's all baked into the market. And so really for the last 2 weeks, with a couple of dramatic up days and down days as the exceptions, the market is leaderless, rudderless, and aimless.
Shares of energy companies fell, weighed down by another slump in oil prices, which settled at their lowest level in 2022, as concerns over the outlook for global growth wiped out all of this year's gains. Shares of Apple fell after Morgan Stanley cut its estimates for iPhone shipments for the holiday quarter. Shares of Tesla lost more than 3% amid concerns of disruptions at its factory in Shanghai, where fewer cars than expected could roll off production lines this month. And finally, shares of Carvana lost nearly half their value after Wedbush Securities downgraded the used car retailer's stock to underperform from neutral and slashed its price target to $1.